Hello everyone, how's it going? Today's video we're going to talk about ENDP or ENDO International PLC, an Irish pharma company. So this video is brought to you part by, of course, myself as the narrator, but especially you, the viewers. In part because I have seen a very important attraction or attention brought to this particular company before and after the bankruptcy. And I want to talk about it because, well, of course, first of all, it is an interesting company to cover. A lot of people are going to watch these kinds of videos. It's good for my channel, so this is for me. And as for you, I would say that it's important to cover them because, first of all, not that many articles or online sources even talk about this company anymore. And even with information from the past, I think that very often it's important to bring some refreshers to our memories, because we do have a very short-term memory these days, and it tends to get shorter as time goes on, right? So ENDO was initially a company that has picked up by people because it was very attractive to trade the prices. It had some very wild volatility runs back in 2020, 2021, and also in 2022. I'm sure that each time they're for different reasons, but let's just say that they almost always have the keyword volatility, which is a synonym to opportunity or loss in this industry. So ENDO has been having a severe debt problem before the contingency with the class action lawsuit even kicked in. So what do I mean by that? ENDO is massively financed by having debts. They borrowed a lot of money from institutions, banks, credit unions, private investors, what have you. This is different from equity investment because in equity investment, you don't have to give it back to your investors. They have willingly given the money to this company in exchange of some ownership. In debt scenarios, people who have debts, they don't own the company until the very end. If the company goes to bankruptcy, they usually have the first rights to the assets of the said company. And so this is why having debt can be very detrimental in the long term, especially when you have a lot of it, because you cannot avoid the responsibility or the liability to pay back the principal and the interest in due time. If the company cannot, then this would mean that the company is insolvent. And then it would trigger a whole bunch of additional triggers down the road. So this was the situation, I would say, a few months ago. A lot of people then were very hopeful that the situation can turn itself on, and maybe the stock will get another revival, right? Because from the perspective of the price action, things have been, very bearish, but it also means that things have been more bullish before. So there is a certain probability that things can get back on to where they were if you buy them at a very low price point. And then came the contingency lawsuit, or rather the legal contingency. So this time, it's basically a class action lawsuit against the products that this company was selling, and then as a consequence, the company has applied for Chapter 11 reorganization. In other words, what I would call a soft landing bankruptcy. They're still negotiating with bondholders and equity holders, trying to figure out how to move forward if people collectively decide to do so. Obviously, this doesn't fit everyone's bill. Not everyone wants to see the whole endeavor continue to be dragged on. So people have to decide, the stakeholders would have to decide what to make of the whole situation next. The company was traded on the Nasdaq, and it is now traded over the counter. Nevertheless, it's worth pointing out that this detail matters for the ownership structure and also for the institutional managers. It doesn't really matter for retail traders because for many brokers, you actually have the capacity to trade stocks that are over the counter from the browser or from the software itself. So for us, it's like zero to no difference, right? However, it does move into the fact that a lot of institutional money cannot touch OTC stocks, no matter how prestigious or how prestigious, like formerly prestigious, shall we say, they used to be. So this is something to consider. And like as soon as the company switched from NASDAQ to OTC, or from solvent to insolvent and applying for Chapter 11 bankruptcy, things have changed drastically from a shareholder point of view. Currently, ENDO is owned very little by the institutional owners and mostly by the retail traders. So, in this whole kerfuffle, basically it all depends on if the negotiations will pan out. If they don't, the stock goes to zero. And if they do, the equity would probably jump as a result. Currently, the equity side of things is likely one of the biggest losers of those changes because basically, whenever a company applies for bankruptcy, 11 or 7, it's likely that whoever owns the shares of the previous version of the company, if you will, they will bear most of the blunt. So that's just how things go. And is that a good or bad news? Well, in my opinion, for the company, if they can continue the operations despite Chapter 11, meaning it doesn't go to liquidation, then this is inherently a positive news for the company and for the economy all by itself. However, for the shareholders, it really depends on at which price did you buy your shares at. If you bought your shares like around 10 to 12 pennies, like where it is now, then this is a massively good thing. But if you held the stock since maybe a few months, then it's a completely different story. So, of course, like always, things depend on what is the entry point. So, the good news, sort of, is that the price action currently shows a huge amount of deflation, which is the big loss that we've mentioned. And then there's probably far more upside than the downside if the negotiations turn out to be constructive. The bad news is things can still go bad. And in that case, the stock could still go to zero, potentially. Nobody wishes this to happen, but you have to understand that this is a company that has been substantially emptied of its assets and its potential values. So going forward, people have to decide if they want to continue the operations with the current shell, or if they want to just start from scratch. They can change names, they can change their brands, they can change a lot of the marketing materials, because let's be honest, this is probably a necessity if they want to continue the operations either way, right? And then the whole process might take months or even years. But in my opinion, right now is one of those moments when you will have to sit down and to think if you are the kind of investors who can take on this kind of position. For example, if you're very risk tolerant or, very diversified in your investments and you're willing to take on this kind of risk, then by all means, now is a good time to buy it. But you will definitely have to factor in the possibility, which is material possibility, that the stock might go to zero in the coming, weeks or at most month. Because a final decision would have to be made at some point. And I don't think that this is going to drag on for like years, right? So this is the kind of investors for whom ENDO right now presents a good opportunity. The other thing is it also depends on your appreciation or not of companies that have either gone to bankruptcy, Chapter 11, or if companies that have gone through delistings, they still strike your fancy. So for example, companies that almost went to a bankruptcy include AIG and Hertz. Hertz may not still be out of the woods completely yet, but I'm just using those two as an example. So AIG never fully recovered from where it was before the '08 crisis. Its stock, I think, reached like thousands or at least in the high hundreds before 2008. And then afterwards, it went to like units of dollars before slowly growing back to around $50 before taking another hit around 2020. So, yeah, over time, if your entry point is sufficiently low, this kind of company can make you money and can make you a lot of money no matter what. However, if you think that this kind of scenario, for example, it has declared Chapter 11 bankruptcy, right? But what if it doesn't pan out well? What if you're more worried about the stock going to zero than the stock jumping as a result of like favorable discussions with stakeholders? In that case, it's better not to touch ENDO with a 10-foot pole or even a 15,000-foot pole. So this decision is entirely up to you. For me personally, I would have to look at my current portfolio and to see if I have a place for ENDO, because its risk profile is far higher than most of the holdings that I have. And time will tell if ENDO will be able to land itself on its feet again. I do wish that things will get better, but of course, there are some rough rides to be expected. My personal recommendation for exposure, well, first of all, do I recommend buying the stock now? Yes. There's only 10 cents between this and the bankruptcy. So, in my opinion, if you buy it now, there is a decent chance to see it going higher. With, of course, like I said multiple times, the possibility that it might go bankrupt. So, your position size has to reflect this risk. I would recommend to commit between 0.5 to 1% on the stock, maximum. So I would recommend to commit 0.5 maximum if your portfolio is like moderately diversified. If it's super diversified, so 20 positions in multiple sectors and onwards, then yeah, sure, by all means, you can go up to 1%. Now, I do recommend to dollar average in this company in order to profit from the short-term volatilities if there is any. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in the investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks with the expectation that they will be loaned to businesses. Normally, that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.